Meanwhile, the impact of an elevated interest rate climate continues to play itself out in the South African economic landscape. That says consumers are still under financial pressure, despite a lengthy pause in the repo rate hiking cycle following an aggressive approach to fight high inflation. Analysts have forecast that the current environment may be ongoing for a little longer. Head of Product at FNB Angela Glover discusses the dynamics with us. A good afternoon to you, Angela. South Africa's repo rate remaining unchanged since late last year. Has that provided any relief for consumers?
Good afternoon, and thank you so much for having me. I think, yes, the rate remaining stable for the last few months has helped a bit. We're grateful that we haven't seen more increases within the credit space, especially. We do foresee it staying flat for a while. Of course, we never know what those decisions might be in terms of the rates, but we do hope to see a decrease in the rates in the coming months, which will then give consumers real relief.
Speaking of relief, how then can one work around creating that cushion to mitigate in a high interest rate environment?
You know, there's a few options available to you. Of course, it's difficult when the rates are already high to say, these are the things that you can do kind of to prepare for this situation. If you have the outlook that the rates could increase, which is possible, you do have the possibility of fixing a rate. You can contact your bank at any time and ask them for a quote on a fixed rate to see what you could lock in. You can lock it in for 1 year, 2 year, 3 years, or 5 years. Depending on the outlook at the time, you would either get a premium or a discount on your current rate. So that can help you to just get certainty in terms of what your repayments are going to be.
You touched
in terms of actually building up a buffer, to build up a bit of a buffer, we also advise that you pay off your highest interest rate debts first and then focus on your lower interest rate later.
Pardon me for my earlier interjection. You touched on an issue that is one of the most asked questions when it comes to fixing of the lending rate. What are the pros and cons there?
So the pro is really the certainty that you get, because then you know that you are going to be paying that interest rate and that repayment over the term of that fix, be it the 1 year or the 5 year that you select. The cons are that if the rates start to decrease while you're on a fixed rate, then you won't benefit from that decrease until your fixed rate expires. However, if the rates increase while your rate is fixed, then your rate stays constant. So then it's to your advantage. So it's really a bit of a guessing game in terms of which way the rates are going to go while you have your rate fixed. But like I said, you can contact your bank or your home loan provider to find out what that quote would be at that given point in time. And then you can make an informed decision on what you think is going to be the best for your personal situation.
Making an informed decision is of paramount importance there, and what should really inform that decision to choose whether you fix the lending rate or not?
Yes, so again, it's down to your personal circumstance and what interest rate you'll be quoted at that point in time. So when the bank looks at your own profile and quotes you an interest rate, be it fixed or variable, they're going to look at your personal credit profile, your credit score, and your credit behavior to that point in time. So we always encourage consumers to remember that your credit behavior over your entire economic activity is tracked, so that when you need that credit, the bank looks at how risky you are, how likely you are to repay, and then that's priced in. So if you have somebody who has always paid your credit agreements back, never missed a payment, never gone into arrears, that's really going to play into your favor when you need to take out more credits, or when you need to ask for a new rate, or when you need to apply for any kind of lending with any institution, because we do look at that behavior. So we also encourage you to try your best to stay up to date with all payments on all credits.
What also has been touted and playing in one's favor in this regard is a high interest rate environment. Once there is a decrease, it bodes well for the longevity of how far you are going to pay that particular debt. Talk us through that dynamic and how important it is to basically wait and stay within the game and play that long game, as opposed to trying to rush and maybe create these cushions that could not necessarily be beneficial in the interim.
It's always difficult to know what's going to happen in the future, and I don't think any of us ever really get it right. What's important, though, is to understand your personal circumstances. So if you're looking to buy a property at the moment, yes, interest rates are higher than they than they are on average. So we are in a high rates environment at the moment, but the good news is that, they're more likely to come down in the future. So if you are able to buy a property right now and can afford that repayment, once those rates do start to decrease, you'll benefit in that your repayment will actually reduce in time. So you'll end up in a better position. If you buy when interest rates are low, yes, you can maybe afford more, but then as rates do start to climb, then you will start to feel the pinch a bit more. So again, it's down to your personal circumstance. But I think what's important is really to take the long view, especially when you're talking about a home loan, which is potentially a 20 or even 30-year agreement, that you understand that you're going to go through cycles. The interest rate's going to go up, it's going to come down. You can mitigate some of that by fixing your rates, but you still need to be able to cushion those blows as those changes happen.
Thank you so much for your contribution. Angela Glover is with FNB talking us through the dynamics around monetary policy in this country and the impact it has on all our pockets, particularly homeowners.